I'm Kostis Tselenis. I'm a senior investment professional with a focus on sustainability and impact investing. I'm working with Quadia, a pioneer investment manager with a focus of allocating private and institutional wealth into impact strategies. It's the 1 million word at the end of the day. The investor needs scale in order to be able to leverage on the very costly initial process and the very high risk that the investor is taking before investing in a venture. Not a lot of entrepreneurs know that, but if we're talking about early ventures, so venture capitalists at the end of the day, they're taking huge amounts of risks and they're losing a lot of money until they make money. The reason is that most of the ventures out there, I feel that 9 out of 10 will not survive, and most of them because they would not have managed the necessary scale. So that's why I said it's a very important word, and it's important not only when we're talking about entrepreneurs, but also when we're talking about fund managers. It's extremely difficult for a fund manager to be viable, sustainable, financially viable with 10 million assets under management. Okay, and we see that in the impact world very much. So they need, this is an area where public finance can provide support with programs that support, for example, fund managers to finance their operations until they reach scale. This is what's going to help impact investing. But also on the entrepreneur side, again, you need to scale up, otherwise you'll die. Most of the cases of successful ventures is not necessarily because you have a very strong IP. IP can be challenged, even if you have 50 patents. It's the first mover advantage more that counts. And the first mover advantage is connected to scale. You need to be able to scale up as quickly as possible. So scale is one of the many examples why scale makes sense. I'm not going to mention the economies of scale where you're getting bigger. I'm not going to mention the importance for the investor when the deal is growing. So that you can allocate more capital in something that you trust. This is also beneficial for your own clients that are providing you the capital to invest in. So wherever you're going to look it from, this is a very important parameter. Programs, I would say, could be an answer. We need maybe state-funded, public finance-funded programs that provide that investment readiness training, expertise, education, knowledge to groups of ventures. Or maybe, as an alternative, training of the right experts that can help the ventures. So maybe a program that would then pool experts that are out there, train them further if it's necessary, and then send them out to the impact world to be able to help all these entrepreneurs do what they should do and what we mentioned before.
Thank you for that. Some good ideas to write down.
Yes. Again, it's a little bit, investment readiness is the holy grail, and especially in the impact investing industry, right. Because we need it. We need it on all sides. The investors would like to have better ventures to invest in. The entrepreneurs would like to be more professionalized to address higher amounts of capital and scale up their businesses. But it needs still, I think, the only way to address it effectively, as I said before, is probably through very focused programs with good people that they know what they're doing. Maybe that they have the investor expertise, so they know what investors are looking for, and other people that were entrepreneurs at the same time, so that they know the challenges. So those would be the ideal advisors, people that combine both worlds, and they have seen that from both sides. That would be my first idea, yes. No, it's a very interesting question, because corporate investors can be game changers in the sustainability and impact investing field that I'm active in. As I said before, they bring a lot of the market knowledge to a new venture. There are a lot of sensitivities, that's clearly, but we see first of all, we see a lot of corporations launching venture arms, right? Nestlé has one, Danone has one, and they can bring the venture. Some of them have different goals, and I know that the market says that most of them actually want to kill innovation, or want to acquire innovation by being invested in the venture early days in a cheap way. It's not always the case. I think this is a simplification if we say that. It's not always the case. I feel that, of course, there is a clear interest from corporates to increase their innovation capacity by investing in interesting ventures and to learn. Entrepreneurs are sometimes reluctant because they see the sensitivities, the conflict of interest. But again, do you want a venture that is 1 million worth without a strategic investor? Or do you want a venture that you have less percentage maybe and will potentially be acquired by the same investor, strategic investor that has invested in the early days, but is a 20 million worth? I think that the role and the goal of early young entrepreneurs is to be serial entrepreneurs, not to take the companies to the IPO. This is what I've seen before. So just focus on what they do best, which is bringing a very early company, an idea, making it successful, and then handing it out, selling the company and focusing on their next venture, not being there forever. So if you think like this, if you have the same mindset, then you won't have a problem with corporate investors. Actually, you would welcome them. You just start here instead of starting there. It's very clear. The company that I mentioned before that really drew my attention, they actually it is a competitor that they got on board as a strategic partner. It's exactly, it's a communications company and that is already in the e-mobility space. But I think their venture has more chances of surviving, and of course it appeals better to investors like us. So I think, every case is individual, and you have to see the sensitivities. The entrepreneur should know better. But overall, investors like us are always very positive to strategics and corporates where we can share the risk. And entrepreneurs should be as well, I feel. The standardized scorecards that we see out there, it's a good start, but we do it customized for every single investment. Therefore, it can also not be so relevant.